All right. Well, welcome everyone. What a pleasure it is to spend this afternoon, the next hour of this afternoon together here in our third version installment of Relief Consulting. What matters most matters more. I'm CJ Blankenship. Glad to be here with our team. Paul Anglin and Larry are going to be joining me today as we talk about the loan forgiveness application. Much anticipated, much awaited news that has come out a little over a week ago, and I look forward to sharing our blueprint and a variety of other information surrounding this. With that, Ben is going to be running our slide deck today, so do you mind advancing the slide there for us, Ben? And then saying a quick prayer to get us started today, if you don't mind, sir.
Sure thing. Lord, we thank you that you provide us hope in times of challenge. You provide us peace in times of turmoil. Lord, we pray, are just thankful that you are never changing, never ending, always loving, always good. Lord, we ask that you give us wisdom to take advantage of these programs that are out here. Help us to understand and to make wise decisions. Thank you that you are with us. In Jesus' name we pray. Amen.
Amen. Thank you so much, Ben. Well, with that, let me get to our meeting logistics. If you've been on one of these with us, same basic background as others. Chat rules, Mr. Chris Griffin, my longtime partner here at the firm, here long before I got here, is going to be manning the chat, I believe. So, Chris, if you don't mind, pop in a little chat, let it open up down there below. Feel free to go ahead and accumulate your questions there. But even if you do know the answer, if you don't mind, please refrain. Look for answers from Larry, from Paul Anglin, from Chris Griffin. I'll try not to hop in there because I get super distracted. Ben Smith or Karen Stevens from our firm, or Tom Bates, some of the partners and directors here that'll answer those questions if you don't mind. On our website, to bcpas.com, lots of information that's out there as we've continued to update it with the write-ups that surround all of the different relief provisions that have been granted. Also, if you would like any information at all, including today's presentation, just drop an email to info@bcps.com. We'll get a quick response. And obviously, this is being recorded, as have the other previous events, which we're going to kind of cover here in a second. It is up on, and will be up on the website. Version 4 of the Relief Consulting Toolkit. If you have not gotten a copy of this toolkit yet, please reach out to your CPA and make sure to receive one of those, because it literally is a book at this point, but has all the blueprints, the master blueprints, write-ups, plans, just such amazing content that has been developed by our team. Just really exciting about that. All right, Ben, we're going to show you our quick circular 230 disclosure that's required as part of our being a CPA here in the United States. Basically, in conclusion, this is not tax advice. It's not to be relied upon as tax advice, but it is very good information that we want you to utilize to have an individual discussion with your CPA here at the firm. Excellent. So what are we doing today? Today, our perspectives on finding relief. Our first event, the master blueprint, what matters most, kind of in the heart of what was going on. It was a series of mini events, had I think 600-700 of our clients attend that. It's sort of a background that we have laid into that we continue to build upon. Event number 2, if you missed it, the recording's up there, PPP forgiveness and finding your unique space on the liquidity forgiveness spectrum. We're going to actually not replay that, but at the very end, just a quick reminder on that and an update on the PPP strategies. Today, we are talking about loan forgiveness specifically, new information that we have been provided with from Treasury that helps us shape what direction to go. And it's really good timing because there's still a lot of decisions to be made here in the final, depending on when you were funded with your PPP loan, your 8-week period, alternative period that we're going to talk about today. Time is of the essence to make final decisions, get that right pace on the spectrum, and then get the right application ultimately submitted, which we're going to spend a lot of time talking about today. pretty intense application, to say the least. Paul's going to share some thoughts with us in just one moment on that. So that's our objectives today. You can see our 4 points here. Give us a foundation ultimately for the conversation with your CPA. So the content, we're going to go through the master blueprint, just to highlight where we are on there. PPP loan forgiveness application components. We're going to talk about forgiveness, and we're going to do this in a Q&A sort of format before we get into the actual loan forgiveness blueprint itself, because there's a lot of defined terms, there's a lot of overarching concepts that if we just jump right into the blueprint, which you're used to probably seeing at this point, it's we need some reference for that. We're going to clarify some of these PPP strategies, and then lastly, just a quick review, not in detail, but in concept of the forgiveness liquidity blueprint. So where are we right now on the master blueprint? We're down here. Remember, we talked about deploying the margin, capitalizing the viability. If you haven't seen any of those presentations, please go to the website, watch them. But we're down here in this PPP side, little bitty green box down here that we're focused in, and we're going to spend the whole hour today really down in the spot, because this is kind of the culmination of so much work that has transpired from so many team members, so many clients. And I've been blessed, candidly, with just a great program that has honestly really saved many businesses and been able to lift up and encourage other businesses, and for others has just provided a really unique opportunity to continue to retain and grow even through this period. So with that, I'm going to ask Paul Anglin to just give us a quick conceptual framework for this application. We're not going to dig into it, but he's going to give us some overarching thoughts before we get into the next section. Paul?
Thank you, CJ. The PPP forgiveness calculation form, it's relatively a fairly simple looking form. There's 4 pages that need to be completed. So it doesn't seem that daunting on first view. There's a loan forgiveness calculation form, which is the form we're seeing here on the left. And there's also a representation and certification of the borrower that you see on the right of the screen that we're currently looking at. And again, seems fairly easy conceptually, but this is a lot like a tax return in many aspects. If you think about a small business filing a Schedule C, that Schedule C number comes over the main form of the 1040, and it just, one number and you move on. But the effort and energy to get that Schedule C completed correctly, and heaven forbid if you were with an audit, which some of this will feel like that, coming up with the documentation to support the numbers on your Schedule C, this can really be the devil in the details when you look at all the required documentation that will be needed to be submitted for the loan forgiveness process. But if you want to go ahead to the next slide there. So the next 2 forms are the Schedule A, which is on the left. Again, not a very scary looking form, but I would direct our attention to the one on the right, and that is the PPP Schedule A worksheet. And this is really where the daunting task, intensive work will come into play, because all of this will need to be completed on an employee by employee basis. So, maybe high level thoughts here. If you had the same amount of employees that were being paid the same amount of compensation or more starting back in January of 19 to date, this may not be very hard to complete and probably would result in 100% forgiveness, and you can move right along. I'm not aware of too many of our clients that have had that scenario with the furloughs, layoffs, just all the uncertainty we've had. It's really going to be challenging going through these calculations and making sure not just to get numbers on the form, but are we getting the numbers on the form to get the best answers that we want? In our previous conversations, we've talked about maximizing loan forgiveness, or it may be maximizing liquidity and other needs. So I think there's going to be a lot of play of what we really need to think about, look at, and how we document. Just to give you some idea of the documentation that's going to be required, thinking from a payroll perspective, bank statements or payroll provider statements are going to be required to be submitted with this form. Forms 941 and state quarterly wage reports. What about contributions to employee health and retirement plans? Yes, those will need to be documented and submitted. What about non-payroll costs? Think about amortization schedules for mortgages, lease agreements, canceled checks as it relates to utilities or invoices. There's going to be a lot of documentation that's going to be required. So again, my caution here is, even though it seems like a fairly simple 4 pages of forms, that there is going to be a lot of time and effort to get the documentation gathered and completed, and to get the right amounts going on specifically this PPP schedule, a worksheet that will flow into the rest of the form. So again, looks fairly simple, but obviously the devil's in the details. CJ, any other thoughts you have there?
Thank you, Paul. That was a great overview. And I think that, one of the things Paul talked about here was that, you look at the form itself, like lots of tax returns, there's not a ton of lines really in the whole scheme of things. But the overarching concept here isn't so much putting the number on the line, it's which numbers to put on the line. And because we're going to talk about this in just a moment, the underlying scenarios, the underlying base periods, the multiple choices that you actually have of which number, which period, which employees should be excluded, as we're going to talk about here in just a little bit. It's a little bit deceiving. This is actually a pretty intensive process that has actually a wide array of outcomes depending upon the underlying assumptions and the periods that you adopt, as well as the safe harbors and a variety of other things. And so a little bit deceiving on its surface, right, Paul?
Absolutely. Couldn't say it better, CJ.
Well, great. Well, with that, I'm just going to give us a quick teaser, for lack of a better term, on our the blueprint that we're getting ready to go into. And I'm doing this intentionally so I don't lose you over the next couple of minutes, because we are about to, we're going to get into this, and it's going to make a lot more sense if I just we start talking about this right now without running through some of this Q&A here in a moment. I think that we might get a little bit lost. So I'm going to ask you to buckle up your seatbelt for the next roughly 10 minutes. If you can hang on, we're going to go through 20 in-depth, very important developments that have transpired. So just sit back, buckle up, and get ready. And so with that, I'm going to bring Larry, Mr. Triple P Clume, who you have gotten used to hearing about. He's been one of our resident expert here, and we're going to just go as fast as we can through these next couple questions. And so without having too much introduction, Larry, welcome. Thank you as always, sir. So talk to us about the economic uncertainty. There was a lot of uncertainty around the uncertainty question. What happened?
Sure. Good afternoon, CJ, everyone. The economic uncertainty question really was put to rest a couple weeks back when the SBA came out and said there would be a safe harbor if your loan amount was $2 million or less. Everyone had to represent that due to economic uncertainty, they needed the loan to support continuing operations. And for some larger, well-capitalized companies, the Treasury was coming out and saying you might not qualify. But the safe harbor is really very useful. Most of our clients are under that $2 million level. If you're above it, you still have to make the certification that due to economic uncertainties, you needed the loan to support ongoing operations.
Yeah, for those more than $2 million audits, which we have those out there, Larry, as you and I were talking about earlier today, the uncertainty of the economic conditions, we've been having some specific conversations, make sure those documentations are well, but some great news on the less than 2 million. So we were asking a lot of questions about whether or not for payroll timing, people were getting loans right around payroll dates. And the question was, well, is it the date that the money comes out of my bank account? Is it the date that I pay folks? We got some really good guidance on this, didn't we, Larry?
We really did, in a couple different ways. One is that we're allowed to use cash method of accounting on the front end. So if you pay a payroll early in your covered period, that counts even though the days earned were prior to the covered period. And then at the end of your covered period, you're allowed to include the first payroll after your cover period, those hours earned by your employees during the covered period. So it really gives you the best of both worlds, and effectively it extends the covered period to a period between 9 and 10 weeks rather than the 8 weeks that are listed in the statute.
Absolutely. And we also found out during this period, coming back to this payroll question, there are a lot of questions around what the $100,000 limitation was going to look like. So in other words, if you do the simple math on it, 850 seconds of 100,000 is 15,385. There were concerns where if folks maybe made 10,000 in one payroll and then another amount that was lesser than that, maybe 4,000 the next, it might be limited. Turns out it's just a period basis, right, Larry?
Right. We're going to total the amount of compensation every employee got during the 8-week period, and no individual employee can be more than 15,385. That could be 10,000 in week 1 and 5,385 in week 2. They're not going to cap you by pay period.
That's great news. And one of the other things that came out, as Larry was talking about earlier, we start getting these alternative payroll covered periods here in our payroll cost possibility. So we have some choices, don't we?
We do. This was a nice benefit that the government provided for those borrowers who got a PPP loan a day or two after they remitted a payroll. It didn't seem fair. And so what the government has allowed now is you may choose your standard covered period for payroll, which is the 8 weeks that starts the day you got your loan, or you may select an alternative period which starts on the first day of the first pay period after you get your loan. So you'll be able to count all of the hours earned by your employees in that 8-week period. The other nice advantage to this is it extends the time when we're going to start measuring your payroll. Many of our clients had employees on unpaid furlough earlier in the spring, and now that we're starting to reopen, many employers are starting to call back employees. So the longer you can defer starting your period, these type of employers are going to benefit from that because their employees will have already been called back to work for a greater portion of your covered period. So this was a real nice benefit that the government provided.
As we refer to this APCP, this alternative payroll cover period, you hit the nail on the head there, Larry. Folks were in this furlough state, and maybe this hit 2 days into the pay period. The opportunity to potentially go ahead and defer, bring back folks, and pick up an extra couple of days or even weeks, depending on how often they pay, is a real opportunity to create a base period here, a testing period, a covered period that might have a better result, particularly when it comes to some of the phase outs and reductions we're going to talk about.
Exactly. It adds quite a bit of complexity, though, because you're going to have to do these calculations multiple different ways to see which method is going to optimize your result.
That is exactly right, and that's our point here. Multiple calculations, multiple periods, and multiple options obviously are going to create a long list of varying outcomes. It is a real exercise beyond just pulling numbers. It's making a decision of which numbers to be pulling, which requires really analysis of all of them. But now this alternative payroll cover period, it doesn't apply to our non-payroll costs, does it, Larry?
That's right. So if you do select the alternative period, it's only for your payroll costs. Your other costs, which would be rent, mortgage interest, and utilities, continue to be the standard 8-week period, which starts the day you got your loan.
Mm-hmm. And, in that concept, we did get some great relief around some of these qualified non-payroll costs. We're going to go through a couple of these here. But big picture, we were really wondering about prepayments. Seems like there might be the opportunity to take advantage of a little bit of that.
Yeah, the guidance does not have a stated prohibition on prepayments. So within reason, you may be able to include prepayments in your qualifying costs. And on the other side, here too, with your non-payroll costs, you're allowed to include in your qualified costs the payment of items that were accrued or incurred prior to the end of your covered period, but paid on or before the billing date. So think of it, things like your utility costs. They accrued during the month of June, but the invoice isn't due until July 4th. If your covered period ended June 30th, you can include those June costs in your forgivable costs, even though you didn't remit the payment until July 4th. Very nice.
But it is important to make sure to make that payment on July 4th, right, Larry?
Yes, it does appear that the guidance requires you to make that payment timely. So don't be late on that payment if you want to include those costs.
That's right. And so now what are we thinking about these prepayment of qualified payroll costs, specifically things like retirement benefits and health insurance? Incomplete guidance, but we've got some questions.
Well, that's correct. These are qualified costs, your health insurance and your retirement benefits, and it's a double benefit if you pay these qualified payroll costs, because as we'll see in a short while, or we just have seen, your forgiveness is limited to 75% has to be used for payroll costs. So you want to increase to the maximum extent possible your qualified payroll costs during the covered period.
That's right. And so moving on here to this next piece around owners, right? Maximum qualified payroll costs related to salary. We know for sure that owners are going to be potentially excluded from some of these.
They are. Owners, one thing we know for sure is we're not allowed to include benefits, retirement plan benefits or health benefits for owners, and that would be sole proprietors and partners. On the positive side, we know exactly how much we can include for the owners. It's 8/52 of their 2019 income as filed with their 2019 tax returns. We have this quirk where partners also have to multiply that number by 92.35%, but we know the dollar amount. Also, one of the things in the guidance you might for our owners is they should actually pay themselves their 8/52 of last year's income. Seems unusual, but it looks like the government certainly used the word paid on the application.
So I'm going to kind of skip down here to this 25% rule that came out. A very pro-borrower result in the application, as it turned out.
Yeah, when we looked at the application, we saw the ordering rules were changed. We anticipated that our non-payroll costs would be limited to 1/3 of the payroll cost, or 25% of the total, before we applied the reductions. But that's not how the application was put together. So from the core of the application, we can sum up total qualified costs in excess of our loan amount and then apply the reductions for FTEs and 25% wage reduction. So this too was a benefit to borrowers in this application form that SBA put out 10 days ago.
Yeah, it really created some opportunities we'll talk about here in a second. And then owners, it does appear, we have this concept of 2019 PPP eligible SE earnings. Looks like we might have some different components of this in that 15,385 number we talked about earlier for Schedule C filers, general partners, and owner employees.
Yeah, this is something that's kind of hard to understand why the government did this, to treat sole proprietors and partners differently, but they did. Sole proprietors have to use their Schedule C line 31, which is the 2019's net taxable income for them. But general partners have to use their Schedule K line 14A self-employment income, but they have to multiply it by 92.35% and then take 8/52 of that number. Sole proprietors do not have to reduce it by that percentage. The theory there for partners is that they're backing out the so-called employer portion of FICA taxes, but sole proprietors don't have to do that. So there's a difference in treatment.
Yeah, and owner employees are even treated differently than that. So just another one of these nuances that comes out on occasion that is kind of a scratch your head, very interesting. And so with that, Ben, if you don't mind, move to the next one. And this is a big development here, which we're really excited about. But it starts creating, this is where we really start seeing these multiple facets coming into play, is the full-time equivalent employee calculation and determination of the period. So Larry, share some thoughts about this. This is one of the biggest developments we had.
It really is. It adds a significant amount of complexity to the calculation because, first of all, we found out from SBA that the full-time employee is one that works 40 hours per week. Which is a pretty high standard in today's society. Many employees that are considered full-time work 38 hours a week or 35 hours a week, but 40 is the standard. The government also gave us a simplified method where you could, if you choose not to do it, treat your employees as full-time if they work 40 hours a week, so they would count them as one, And then all your other employees would be counted as 1/2 employee. So this, again, adds complexity because there are actually 5 different measurements where you have to do your full-time equivalent employees, and then you can do it 2 different ways. That's 10. We are hopeful, and we think many of our employers will qualify for the safe harbor. If you can qualify for the safe harbor, you can avoid all of these FTE calculations. And the key there is that during the period between February 15th and April 26th, you had a reduction in your full-time equivalent employees. And then on or before or at June 30th, your full-time equivalent employees are equal to or greater than they were at February 15th. If you meet that rule, you're considered to have met all the FTE requirements, and you don't have to do this employee by employee calculation. So hopefully many of you are going to qualify for that safe harbor and avoid all of these difficult computations.
That's right. And for the folks that don't, though, Larry, your point, 5 different calculations. You have to choose which period, the alternative period or the actual 8-week period from the date of funding, 10 different outcomes. All that leads into one number on one line. To Paul's point earlier, just the devil is in the details, so to speak. The big development there. Employees declining to work. Basically, Larry, if you've given them a good offer, we're not going to go through all the details on this, and you've documented it, and they rejected it, as long as you then follow, this was an interesting addition, make the actual reporting to the unemployment agency at the state level. Good luck having that conversation. Then they get to come out of the numbers, right? And the same thing for folks who were terminated for cause.
Exactly right. This was a common question a few weeks ago. What happens if my employee won't come back to work? We're now allowed, as long as you've made them a written offer for the same hours and the same pay, they can be included as an FTE. Also, those employees that are terminated for cause or that voluntarily reduce their hours can be included as an FTE. But you need to document that, and as CJ mentioned, somehow you're going to have to report to the your state authority that employee refused to come back to work.
Absolutely. And so, you know, one of the other big things was this hourly wage reduction. We weren't sure, it was, you know, the 25% rule, whether it was going to be a cliff. If somebody was making, call it $80,000 and they were dropped below 60, we knew that there was going to be a reduction. We didn't know if it was going to be, if they were at 59,000, it was going to be a $1,000 reduction in the forgiveness amount, or 21. Very clear, it is dollar for dollar below 25%, not a cliff, right, Larry?
That's right, although the SBA gave us some really nice accommodations here and made it very, very simple for hourly paid employees. You simply have to have the employee back on the payroll during the covered period and pay that employee the same hourly wage, or I'm sorry, an hourly wage that is no less than 25% of what the hourly wage was to that employee in the first quarter. So if you had an employee making $20 an hour in the first quarter, as long as that employee makes $15 an hour during the covered period, there's no reduction. It does not matter that the employee worked 600 hours in the first quarter and 100 hours in the covered period. It only matters that you pay the employee the same hourly wage. So that is a huge accommodation that the SBA made to borrowers.
Great news.
We don't have
for the
enough
hourly
clarity
employees.
around what happens for our salaried employees. So we're hopeful we'll get more guidance there.
That's right. The average salary calculation still lacks a little bit of information, but great news with the hourly, and also good news on the cliff. It's simply dollar for dollar. You don't go back to that first thing and then all of a sudden get hit. Now, also interesting enough, the good news, depending on how you look at it, is for the reductions. It turns out for the $100,000 base, it looks at 2019, and if any one pay period annualized was greater than 100,000, we get to exclude them from the calculation. So, for instance, bonus periods.
Right. Many employees will get excluded from this wage reduction calculation because of that. So, if you had an employee who had a large commission or a bonus, and you're paying 26 pay periods a year, you take that largest pay period for that employee in 2019 and multiply it by 26. And if that employee is over $100,000, he or she is not even included in the computation. Also, and this is quite interesting, if the employee did not work during the covered period, they are not included in the calculation. So if you had an employee that worked in the first quarter and did not work in the covered period, perhaps you brought them back in the weeks after the covered period, they are not included in the calculation and they're not going to result in any wage reduction. They may have an impact on your FTEs, but not your wage reduction.
That's exactly right, Larry. These safe harbors have been amazing, as we've talked about for the full-time equivalent employee count, as well as for the compensation. These 630 safe harbors are going to be a goal that we're really going to work for our clients that have experienced significant loss of employees and or revenues that have then resulted in cuts, to try and see if, depending on naturally, we talk about what matters most, matters more. We've got to make sure that economically it all makes sense. But it's just one day, and so it's really important that we make sure we try and hit these 630s, especially if we have a lot of money on the line around these safe harbors, because it helps get out of the reductions we've spent a fair amount of time talking about in previous discussions. So Larry, I'm going to let you take a breath and get ready to run through the application blueprint. I'm going to run through these super duper quick. It's just to basically say we don't know what else is coming down the line here. Other limitations could be issued that we are unaware of, just like the 75-25 rule. Turns out we got some great news on how that order of operations is going to work for us. Further limitations on owner benefits in the calculations. Looks like it's getting pretty tight around this 15 through 85. That looks like that most likely is going to be the number across the board for all employee owners, Schedule Cs, et cetera. So that was some information that's been developing over time. This real or personal property. Personal property is an undefined term. This was a nice add for interest and or for lease payments. Instead of just real property such as office buildings, now we get to include things like copier leases and so forth, both the interest on those as well as the rent. But personal property, does this include maybe intangible assets as well that might be personal property? So looking forward to getting a definition for that. Obviously, we did find out for sure that it's not origination date. It is the date that our first PPP dollars are received for our beginning of our covered period for those non-payroll costs and for the payroll costs, unless you choose the alternative period. And Paul did a great job talking earlier about some of the documentation requirements. The short version of this is there is a ton of information that is going to be built into this, and it's not just 1 year, it's actually multiple years of information with a lot of real-time data as well. It is quite an undertaking to complete these. So with that, Ben, if you don't mind, let's go on forward here to just a little bit of some perspective, guys. This is the Treasury website. When we started this first webcast, we had 3 or 4 of these things on here. This is what it looks like today. Well, last night. I don't know. Maybe I put something out today. Every single one of these documents provides intensive guidance around the PPP progress, and all of this is culminating into this loan forgiveness application. And so with that, I want to go ahead and get us onto the blueprint, because this is a great picture. You know, they say a picture is worth 1,000 words. This is a really great representation of how this ends up working. All this information, backgrounds, these definitions, conceptual framework we've rolled through can best be reduced in really what looks like a pretty simple couple of factor formula here, but a lot of underlying information goes into it. So Larry, why don't you spend a moment running down through this for us, and then I'll close out with some perspectives on our blueprint here.
Sure. One of the biggest things to keep in mind is right at the top here is whether or not the alternative payroll covered period is going to benefit you, or you'll use the standard method. So you'll need to do some study around that and see which is going to help you. We've kind of driven home a couple times the fact that your forgiveness amount is going to be limited to your payroll cost divided by 75%. So you want to make sure that you incur adequate payroll costs in getting to that, you know, the golden fleece of getting full forgiveness. Your forgiveness amount is going to be the least, the smallest of those 3 numbers below: the loan amount, your payroll cost divided by 75%, or this modified total. That modified total really gets again to that ordering of computation that we talked about earlier, where you can include all of your qualified costs and your qualified cost in total may exceed your loan amount. And then you apply your wage reductions, both the 25% wage reduction and then the FTE wage reduction. So it's, as Paul mentioned earlier, the computations themselves, as you look at the form, do not look that daunting, but then when you see what is required to substantiate the numbers that go on this form or in these calculations, it's really quite a complex computation.
So Larry, as we start kind of rolling down through here, we have to start off with our payroll costs, which is really divided into two categories. And the application itself does a great job of doing this with the Schedule A, not only for those above 100,000 and below 100,000 employees, but also for the compensation to owners. Do you mind just walking us through real quick how we put these together to get this beginning basis for our calculations?
Well, yes, you know, your owners, well, I guess we have to step back and take a look at what kind of entity we're dealing with. If it's a sole proprietor or a partnership, the owners and partners will include 8/52 of their eligible 2019 income. So this is an amount that for our partners and our owners is a known amount now, or should be. We need to get everyone's 2019 tax return calculated, prepared, ready to be filed or filed. So for our owners and partners, we know it's 8/52 of last year's income, limited to $15,385. Then our other payroll costs are going to be the wages that we pay to our employees, plus the benefits that we pay to our employees, retirement benefits, health insurance benefits, plus our state unemployment taxes. Unfortunately, SBA is not going to allow us to include the benefits for our owners or our partners. So that's step one. Then we're going to add in our non-payroll costs, which mortgage interest, rent on real and personal property, along with utilities. And then we're going to apply our wage and FTE reduction. We are going to encourage our clients or recommend to our clients that one of the things they do early on in doing these calculations is to see if they can qualify for the FTE safe harbor, the June 30 safe harbor. We still have a month to go. So as you're beginning to plan, we would really encourage everyone to take a real hard look. Of course, economics always come into play here. What's the optimal result for you? But in terms of optimizing your forgiveness, we think it's going to be very important that you meet the June 30th FTE safe harbor. It's of all of the restrictions that apply, that's one that is not that difficult to overcome. So we really think you should take a look at that, and if you can, try to meet that June 30th safe harbor.
You know, one of the interesting outcomes in the way that this order of operations ended up working is that the wage reduction happens first, as you can see up here. And so, you know, you get to whatever your grand total here is between payroll costs and non-payroll costs, then pull your wage reductions off. Hopefully you've met the safe harbor and or restored, so you're not going to be subject to this. But regardless, you get to this starting point here. And it's really interesting because there's actually potential now, because the non-payroll costs are not limited to 25% of the loan amount, which was some of the initial, you know, the way that it looked like things were going to be built. We could actually spend a lot of money on these non-payroll costs. Secondary, obviously, we talk about singles, doubles, and triples, which we'll hit on here in a moment. And potentially drive up the starting point if you're really jammed into the full-time employee reduction factor. You could drive up your beginning number before being subject to the limitation, which was an interesting development, right, Larry?
Yeah, it really was interesting that they're allowing the total cost to exceed the loan amount. Also, the reduction factors are actually switched around from the order in which they're presented in the CARES Act. In the CARES Act, the FTE reduction applies first, and then the wage reduction applies second. So again, this was a change that was beneficial to borrowers. Think about a borrower that had a $50,000 wage reduction, but their FTE reduction is 80%. By doing it this way, instead of applying the 80% and then the $50,000, we've in essence reduced the wage reduction to $40,000. So this also was a change that the government made that was beneficial to the borrowers.
Absolutely. And so once that gets applied, to your point earlier, Larry, we end up with these three different concepts down below. The payroll cost requirement, the modified total, as we just went through all the calculations to arrive at. And again, all these calculations we're going to talk about in just one second are all based off of a variety of factors that you actually have some choice in because of your alternative payroll period and your choices around your base periods for full-time equivalents if you're subject to the reductions, or the loan amount itself. And then we're going to pick the lesser of those three, right, Larry?
That's right. So you get the lesser of the three. And then just as a reminder, and SBA did clarify this on guidance they released on Friday, whatever your forgiveness amount is, it's also going to be reduced by the amount of your EDL advance if you did get one of those.
That's right, which is going to be up to $10,000, $1,000 per employee, right?
Correct.
Very good. And so just coming over here to our perspectives, just want to really, drive home this concept of picking your periods because the payroll costs are multifaceted. Picking which period is very important for the actual covered period for your payroll costs. And then really what happens because of that is the timing of your rehiring and which period you're in if you're not going to meet the safe harbor. We do think, though, that it's called a safe harbor for a reason. Shooting for these 630 safe harbors is going to be really important for a lot of our clients that are finding themselves in the reduction. So it's important to do the math and know if we are in the reduction categories. If we are, then we need to turn around very quickly and be able to say, does it make right business sense to hit the safe harbors at 630, assuming you're eligible for them, particularly, for instance, on the FTEs, we've had layoffs between 215 and 426. Or for the payroll cost aspect of things, can we restore those payroll numbers to the right hourly wage or salary wage based on what we're experiencing from an economic standpoint? And so this that FTE calculation method for test, we talked about the simplified or the pro rata. Larry, do you mind just going through that one more time for us so we can understand how those work together?
Sure. The test is going to be applied to the average weekly hours of your employees. And once you calculate the average weekly hours during the applicable period, whether that's your covered period, your alternative covered period, or your two base periods, then you're allowed to apply 40 hours per week to come up with the standard method, which is the average weekly hours divided by 40, rounded to the nearest tenth. So, for example, if you had an employee who was working 30 hours per week, that employee divided by 40 would be 0.75, rounded is going to be 0.8. And no other employee can be more than 1. So if you have an employee working 45 hours a week, that employee is going to be 1. And then the government has provided us with a simplified method. So going back to my example, you have an employee that's working 45 hours per week. That employee is going to be counted as 1. And then all employees working on average less than 40 hours per week are going to be counted as a half. So my sample employee was working 30 hours a week, will be counted as 1/2. And the challenge here is, once you pick the method, you've got to apply that method consistently throughout. So you will apply that to your covered period or your alternative covered period. You also have to apply the same method to your base period, which was either January and February of 20, or the other base period you choose, which could be February 15th to June 30th, 2019. You also have to use the same method when you apply your safe harbors. So calculating your FTEs as of February 15th and as of June 30th, and if you had a reduction in employees between February 15th and April 26th. So you can see there's a possibility here that you would end up doing, kind of crazy, 12 computations of your FTEs in optimizing your forgiveness amount.
That's exactly right. It's just another one of these things where one line has so many different potential numbers that you can put on there. You've really got to study it and make the right decision. So, two last closing thoughts here, and I want to move on. So owners, pay yourself more than $15,385. If everybody looks up in the top right, Ben, circle the mouse up there under compensation to owners. Because it is the lesser of these three numbers, we got to make sure, this was an interesting development, but if you were online for more than $100,000 last year, as most of our clients, a lot of the clients are as far as the individual owners, and that's a per owner basis, right? So if you had 10 owners, you're potentially talking about $153,850 of forgiveness here. And so you want to make sure that you actually have paid that cash out during the covered period that you select, whether it's the covered period starting on the date or the APCP. And then also lastly, and Larry, maybe just give us some color on this as we move on, but be aware of rehiring the salaried employees late in the covered period or the alternative period. We can get jammed up really significantly here unintentionally.
Yeah, this is an interesting result because you do not have to include in the wage reduction an employee who is not employed during the covered period. If you have a salaried employee who's been off, and the other component of this is we don't know what the government means by average salary. You really could hurt yourself if you bring back a salaried individual who's been off, say, for 4 or 5 weeks of your covered period to work the last 2 weeks of your covered period. You could then bring that employee into your wage reduction and actually have to reduce your forgiveness by the weeks that individual was unpaid furlough. The better strategy may be to wait for that individual for your covered period to elapse and then bring that salaried employee back before your June 30th date for measuring your safe harbor test and whether you've met that. So I really encourage you to talk to your CPA about how that might interact with your specific situation, but just be aware that there is somewhat of a trap there for your salaried employees.
That's right, and you may even have to consider, depending on the effect of that, maybe if you desperately are needing someone to bring back somebody different or bring in someone new, I should say, and then wait and delay and bring in that valued employee that you want to bring back that maybe has experienced some reductions. So at this point, there's a lot of people that maybe are thinking, Ben, if you don't mind, move the slide forward here, up here at the top. Maybe you're thinking about disconnecting from this Zoom at this point because this has been a lot of detailed information that is pretty in-depth. And I'm just going to encourage you, please don't disconnect. The intent here is to finish strong. And so it's really important. We have worked really hard for so many of our clients to get to this point, to survive so much of this pandemic and the forced closures, et cetera. Some have fared very well, some have not fared very well. But here at this point, I just want to stop and pause and say, guys, yes, there's a lot of information here, but the key at this moment is to finish strong. We've got to find the right space on our liquidity forgiveness spectrum. Now it's going to be easier than ever to get 100% forgiveness potentially with not as much finagling as we would have had otherwise with real dollars and real values. We talked about triples and singles and doubles. It's easier to hit triples than ever before. It's like you've got that guy on the mound that's come up that's tossing 80 miles per hour. He's tossing easy balls that even somebody like CJ could hit. And so this is a great opportunity for us, but we do need to finish strong. These things are time sensitive. One other thought, this form itself, as we've talked about it, it's more than just filling out some numbers on the line. It is actually really what we refer to as a consulting engagement internally. We've got to determine on the front end 2 things. One, what do the numbers themselves actually support, and which period, which facet, which approach do I want to take that's going to give me the best outcome? Obviously, we're developing this internally. But then also in the meantime, we still are in a period, as mentioned earlier, we can make decisions that are going to affect these things. And so we need to make decisions about comp levels. We need to make decisions about rehiring, who to rehire, when to rehire, which safe harbors can I meet, am I subject to reductions? Get all these decisions laid out right now, really over the next couple of weeks, as the earliest fundings are just now, next week are going to start coming to the 8-week period for the full funding 8-week period, not the alternative period. And so there's still some time left to make these decisions. And of course, the safe harbors themselves with that great June 30 date, we will need to keep a very close eye on that and make good decisions. So what is Blankenship going to do? How are we treating this? You might be asking yourself. So I had a great conversation. We're in a peer group with about 50 other accounting firms across the U.S. Had a good call last week, a Zoom meeting like we all do nowadays with them, and really our profession's approach is really getting treated just like a tax return. And so when we work with clients on this, we'll have a a separate engagement letter, and we will do all of it. So that is our perspective. The problem is if we start answering one-off questions without full data, the amount of exposure, candidly, for us and for you as our clients and the potential of underserving you is huge because of these reductions, because of the phase outs, because of the audit potential that's out there, a variety of things. We're going to work diligently with our clients, get all the information, and then do the analysis, determine the best result, and then hand a completed return back over. When are we going to do this? July through September. One of the requirements is the second quarter 941. You also have the 6/30 safe harbor testing date. And so that is really the timeline when we see this coming along. You know, we don't have a due date for this application yet. We would anticipate it has an expiration date written in the top right corner of 10/31. Seems logical that the banks and the Treasury are going to want to have these decisions made before the end of the year. The banks have 60 days to respond once this application is turned in. It's going to be interesting to see how that plays out. Future developing guidance. Literally every week, more information is getting dropped. So we're going to stay on top of this, and then in turn, we're going to train up the entire team. We're going to have a review process, really treat it just like when you hire us to do a tax return, because candidly, this is as complex, if not more complex, than many tax returns that are out there. 2019 tax returns are really going to need to be done. It's interesting the way this has come out. They don't have to be filed, but we need the data from the 2019 tax returns. So if you're on this call and we haven't received your information yet, or we have questions outstanding, we've really got to get moving on these 2019 tax returns. And so between now and July 15th, that's a huge focus for our, Paul talked about earlier, our tax team. We got to crank these things out. So we want to get that process flowing. And then this last point here, I think it's so important that we take responsibility for our businesses to make sure that we are getting on these things timely. We need to have our analysis. We need to have our PPP strategies in place. We need to make sure that we've gone through and run the different scenarios. And so with that, Ben, I want you to go ahead and move forward to our clarified PPP strategies, because through this process, I think what we really found out was that it's a lot easier to get, as we mentioned earlier, 100% forgiveness. These singles, doubles, and triples, it's easier to hit a triple than ever before, which is something that's going to allow us not only to get forgiveness, but also potentially to create added value with our employees and or with our profits and margins. But then on top of that, further reduce the reductions that many folks are experiencing right now in our preliminary runs that have happened as we're working with clients helping to look at these numbers. So, so we have updated this a little bit. You'll see some demarcations that have been able to come off the list from where we moved. And we moved some things up, generally speaking. Things that were aggressive might have potentially moved to moderate, particularly in the administration side of things. That's the far column on the right here on the slide deck in front of you. The other two columns, not a lot of guidance here around particularly the retirement benefits, health benefits, prepaying of certain things. It seems like generally my perspective is we want to be right. We want to be fair. We don't want to be elaborately abusive. I mean, there's a chance the way that things are written right now, just use an extreme example, where you might be able to easily get, with prepaying 3 or even 4 months of health insurance that would fall into the 8-week period. That doesn't quite seem right. So we still have some of these things as moderate to aggressive that maybe on a first glance might say, hey, well, I'll pay 4 months of, I delayed my first month of health insurance that fell during the initial funding, and then I paid the second month real time. Third month was due at the beginning. Fourth month I'm going to grab over here, and now I'm going to prepay that. Somebody comes in and looks at things. There's the old saying, he who tries to swim the river with too much gold sinks. And so we think it's really important as you go through this to really focus on the strategies that we know are going to work. Those are the green ones. And then as you need to, we would work down towards the more aggressive. We do know there are certain things that still must be avoided at all costs. And so we want to stay away from the bright red areas down below. We still have a lot of guidance that needs to come out on these benefits. The administration process itself has been eased. It's been augmented. We're really excited about that process. It's going to be a lot easier to achieve forgiveness. We do want to be careful, though, about opening doors. Using that example of, health insurance payments in the same period. If you open that door and somebody's looking at that, whether it's the banker, or it's the SBA, or it's an SBA auditor going through these, especially if you're over the $2 million mark, because it will be audited, as the guidance has said thus far. We really don't want to open that door because, candidly, this is an amazing benefit that's come out for our businesses. So with that, Ben, I just want to revisit super quick here. If you missed our second webcast, we spent the most of the entire time working through what I think is really just a great blueprint here that helps you understand the integrations. All this has survived with the exception of the decertification day that got moved a couple of times. And if anything, what has happened is it's just gotten a little bit easier because the way the math works. Still have the 75% rule, still feel like our 3 steps moving through here, the recalculation process. You have a couple weeks left to finish this. We need to finish this strong, see what you're lining up to experience, and then from there, make a good decision around, okay, I'm experiencing this reduction. I need to hit this safe harbor to get out of that as of 6:30. I need to have my rehiring plan that's in place that's going to be appropriate, or my restoration of wages by that date, depending on what you're experiencing. I think our 100% forgiveness down there, we've said it's rare. I think that it's a lot less rare now thanks to these liberalizations. And because the economy has opened up faster, not for all, but for many of our clients, than we would have maybe even potentially some of us had anticipated. We're in a spot where I think our economy, it's still going to be a long road, don't misunderstand me, but there's a unique opportunity to where capital preservation, though for many of our clients is still very important. Now I think the tables have kind of shifted a little bit, the scales have leaned a little bit more towards really trying to work on this maximizing of forgiveness because it's a lot easier than it was before. Timing is a lot easier. Your alternative periods are a lot easier. Safe harbors are a lot easier. So I think it's really important that we realize kind of we're going to slant a little to the right, a little bit more towards that 100% forgiveness because it's a lot easier to achieve than previously. And so with that, we're getting ready to run out of time here. I want to kind of close out. Obviously, the chat is moving here, and we'll work on answering all of these questions. But I just want to close with a couple of thoughts here. It's important to reevaluate your projected forgiveness. Maybe a couple weeks ago, we looked at this before we were aware of the alternative payroll period or before we were aware of the safe harbors. Now, we want to re-look and revisit these projected forgiveness dollar amounts, find out exactly where we're laying at, and then go back and look at our PPP strategies and look for those triples and doubles and singles. Start layering those in. They're more liberal than before and less aggressive than before. So it's a lot easier to hit. These are real expenses that you're going to need to pay anyway. So let's just make sure we're making good decisions around the timing, when we're doing them, and how much we are making in those areas. And particularly if you're subject to the reductions and cannot hit the safe harbors for a list of reasons that would be specific to you, then it's really important maybe we look at some of these other ways to maximize that forgiveness. So review the previous materials. We've got 3 great webcasts out there, plus the PPP training we did internally, 4 things. So we will post this. This will be that 4th one on the website. Make sure you've looked at that, and particularly the toolkit. Mentioned it earlier. Reach out to your CPA. We'll have a version 4 coming out with this new blueprint and a write-up on the administration of the loan application process itself. And that'll be on the website as well. Not the blueprint and the toolkit, but specifically the write-up. Just want to also encourage you to say what matters most matters more. All these decisions are really contingent upon your continued evaluation of your liquidity needs, your continued evaluation. Ben, if you don't mind, go back to the master blueprint for me real quickly here, sir. Your evaluation of taking care of the house like we talked about earlier, which was making sure that we have the right employee levels. We have the right decisions around these paid leave credits, the FFCRA. We talked about post and comply. We talked about post and promote. Guys, this FFCRA is something that a lot of people aren't talking about. This is real bottom line dollars that last for quite some time, especially with continued school and daycare closures. You layer on top of that the intensive benefits for unemployment that still last for another couple of months with the pandemic unemployment insurance. Making decisions around that are good for our clients, good for our employees, good for our employees' families. very important. And then looking at overall, what is our good decisions around margin? Where are we creating profits? Making good decisions around redeployment of efforts and energies. And then now what we're finding is these great opportunities, particularly with acquisitions. I was on the phone just 2 hours ago with someone who's been presented with an amazing acquisition opportunity that they're looking into that could be just phenomenal for them long-term wise. Not to be, vulture capital by any means, but to come alongside, help someone else during this time while also taking great care of the company and employees. So some great opportunities to really find margin. We want to continue to focus on working capital, focus on making sure you're at the right equity levels. Very, very important time to be focused on the business. It's not time to let off, the gas. We need to keep going full speed ahead. So with that, I just want to say thank you to our clients. Thank you to the Blankenship team as well. I want to thank you all for being a part of our firm. Opportunity to serve you is unlike anything that we have. We exist to serve our clients and to bring great value. You can see our culture and value statement up here. One of the things that's important to us is looking at things through our clients' eyes. Right now, our clients are seeing a wide array of things, from hard times to maybe some of the best times for some of our clients. In that, we want to come alongside, help out, provide guidance, help you make the right decisions. And then in that, we appreciate the real relationships that we share with so many of you that last decades and in lifetime even for so many. And then I want to say thank you to our Blankenship team who's worked so hard through this time. We've been, we haven't missed a day. We've been in beat, and they have really carried this burden so well when it comes to all of the PPP process, the relief consulting process, all these different aspects. So with that, I'll say a closing prayer and wish you well. Thank you for all. Lord, thank you for this day. Thank you for this time. Lord, thank you for the opportunity to be in this great country, Lord, where we've been blessed with so many opportunities and with so many benefits to be lifted up and encouraged through this time. Lord, we pray that you continue to protect our clients. You continue to protect the employees, Lord, and all the teams, Lord, that support our clients and the businesses we're blessed to serve. Lord, for our team as well, pray that you lift them up and encourage them. Lord, be with our state as we reopen. Lord, pray you continue to protect us. Lord, we pray for our country, that you would give our leaders wisdom, guidance for the next steps. And then, Lord, we pray for this world, that it would continue to be brought back to you and that you would continue to protect it. In your holy name we pray. Amen. Thank you all. Hope you have a great day, and we really appreciate the opportunity to serve you. Please feel free to ask any questions and ask for a copy of that updated toolkit from your CPA. Have a great day.